The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. This is Dave Bellusci here at the WCIRB. We'll get started on our webinar on state of the system in a minute or two, waiting for a few more people to join us. So we'll get started shortly. That one. Good morning again, everybody. This is Dave Bellusci here at the WCIRB. This morning, we're here to discuss our recent state of the system report that was released last week. It's our annual, I believe it might be our 5th annual report that really tries to go into it's our state of the system report that really kind of goes into some of the key cost drivers, industry results, the impact of reforms, kind of emerging trends. So we really try to summarize that for you. I think. Yeah, we're going to take a second. I think we have a copy of the report here as opposed to the presentation. So we're going to, as we get started, let me just kind of go, as we kind of sort that through, let me just get into logistics a little bit. That, as always, we have a number of participants. So if you could ask email your questions through the questions panel to us. We'll get to them contemporaneously if we can. If not, we'll get to them at the end. If for some reason we didn't get to your question or you get a chance to do it in the webinar, feel free to email us at www.wcrb.com communications. And similarly, we have a copy of since these slides are really based on what's in the report, we're not if the handouts panel is a copy of the state of the system report. So here's the logistics on asking a question. And let's move into the material in the webinar. So the first slide is reported written premium. That's gross of deductible. So some measures of premium will see a little bit smaller, maybe a third smaller, because they're after the impact of large deductibles, which are significant in California. This is written premium by calendar year prior to deductibles. And you can see the sharp cyclical pattern, the dramatic reduction from 2004 to 2009, where premium in the market after the last set of SB 899 reforms dropped by 2/3, then rapidly started to grow, grew steadily from 2009 through 2016, and then what we've seen recently as declines in rates have more than offset economic growth, that premiums have started to decline. We're projecting about an 8% decline for 2019. The cumulative impact of our 2019 estimate turns out to be right of the recent declines is about 13%. The next slide really looks at the drivers of that. And essentially what drives written premium are, not surprisingly, the total payroll in the system and what's happening with the rates that are charged in the marketplace. And really we showed 2012, we could really go back to 2008, all the way up to 2015, there were two drivers of it. Early on, it was more about increases in rates, but some growth in payrolls coming out of the Great Recession, starting around 2009. That continued. And in fact, if you look at the orange bar, we're seeing continued growth in payrolls of adding about $1 billion a year in premium to the California workers' comp system. That's a combination of some growth in the workforce. Unemployment's very low now in California, as you know. We've had steady growth in the number of workers of a couple % per year, and also higher wage levels. And so that's producing, about $1 billion a year in additional premium. We expect that to continue into 2019 on the payroll side. However, you could see the flop. Early on during this period, rates were going up. That was adding additional premium, as much as more than $2 billion in additional premium in 2013, for example. But that's turned around now. And in fact, the last couple of years, since premium has been declining, the impact of lower rates charged in the marketplace has more than offset the growth in payroll. We're expecting that to continue into 2019, while we expect to have about $1 billion of additional premium coming from the additional payroll in the continuing, pretty healthy California economy. That's going to be more than offset. We're expecting, more than a $2 billion impact of lower rates. So we're expecting more than $1 billion decline in written premium in 2019. Speaking about rates, this shows the average charge rate per $100 of payroll. This is after all schedule rating credits, premium discounts, and so forth. And again, a very cyclical pattern, peaking at over $6 around 2004 before the prior set of reforms, the SB 899 reforms, plummeting down to about $2. Started to increase from about 2008 to 2015, peaked at about $3 per 100 in 2015, and then has dropped by about a third since that, as of the first quarter of 2019. So pretty dramatic decline. In fact, that $2 average rate, which we expect to even drop further, is about as low as it's been way back since the mid-'70s. So a pretty remarkably low level of average rate now in California. And while there's been a lot of medical inflation since the mid-'70s, that medical inflation has essentially been offset by declining claim frequency over the decades. We'll talk about that a little later, as well as just increasing wage levels. And so we're, again, probably at a 4-decade low in terms of average charge rate in the California workers' comp system. This next chart looks at changes in rates over the last 4 years or so. The green bar looks at what the insurers have filed as their average filed rate that they're charging. They've gone down about 25%. The middle bar is what they're charging. After all, application of schedule rating and other premium discount plans, that's gone down about 33% to, as we talked about earlier, about $2. And then it looks at the average pure premium rate, that's gone down about 41%. So as typically, charge rates and filed rates tend to lag pure premium rates, and since the advisory pure premium rates are down more than those other two, one would expect all else, if it follows trends as in the past, those rates are going to continue to decline. And in fact, when we looked at the data and considering whether we would make a mid-year pure premium rate filing back in March and April, there was an indication of about a further 4% decline in the advisory pure premium rate. We're looking at the updated data now. We have our actuarial committee meeting tomorrow and our governing committee meeting the next week from today. And so following that, we'll be making another filing for January 2020, probably around August 20th or so, somewhere around that time frame. And if the experience seems to be holding where it was a quarter ago when we looked at it back in April, there's probably another decline on the way, but relatively modest. So how does California stand in terms of rates compared to the rest of the country? Oregon, every other year, does a comparison. We provide the information for California across the country, and to adjust for things like different industrial mix. Everything's controlled to the Oregon mix of industries. So the numbers here will be different than other numbers will show, just because this reflects the Oregon mix, but it allows for interstate comparison. So California, even with those declines we talked about, still is a very high cost state. For the last prior couple of times, it had been the highest. It's no longer the highest. New York is a bit higher in terms of average rate. It's over $3. California is down to $2.87, but California clearly among the highest and well above the median countrywide at $1.70. And we'll talk about the key factors that make California a high cost state. You know, part of it's wage level, but certainly part of it's still, high frequency of permanent disability claims, long duration of medical payouts, we'll talk about, and then very high frictional costs compared to other states. So let's go into a couple of cost distributions. This compares where the dollars of the insured system costs are going in 2013, 5 years ago, versus 2018, last year. As you can see in total, due largely to the reforms of SB 863 and some of the subsequent action, legislative action and regulatory action, the overall cost of the system, despite a growing economy and higher wages, have gone down a bit from 15.6 in 2013 to 14.3. In terms of the mix, permanent indemnity benefits are a bit higher proportion, even though the dollars are a bit lower, but they're a bit higher proportion. Some of that's due to the increased permanent disability benefits that came with SB 863, starting in 2013, but continuing into 14. Loss adjustment expenses have gotten significantly higher. They're almost a quarter of the cost, where they were only 17% of the cost in 2013. As we'll talk about, while many of the key cost drivers in California have come down over the last 5-6 years, like medical and claim frequency and so forth, we haven't seen that with frictional costs. They've continued to increase, and now it's a bigger share of the overall circle. The most dramatic difference is with medical. The greatest impact of the recent reforms that have affected medical. And on top of that, we've seen dramatic reductions that we'll talk about in pharmaceutical costs. And that's driven medical from $6.5 billion in 2013 to only $4 billion, or only a little more than 28% of the total versus 41% of the total in 2018. Let's dig into that medical piece a little bit. This compares the paid medical benefits in 2013 versus 2018. Again, the dollars have gone down somewhat, but that's, again, with a growing economy, more workers in the system. Again, the most dramatic difference is what's happened in pharma, where it's gone from 10% of the paid medical benefits in 2013 to only about 2%, so 80% reduction. Again, pretty dramatic. The largest increase has come from payments that are made directly to injured workers that have gone from about a quarter of the system to a third. The vast majority of these are the future medical settlements that are part of compromise and release claims. Well, let's move on to claim frequency. So in terms of claim frequency, this compares the change over the last decade or so, comparing what we've seen in the Los Angeles County, LA Basin area, the rest of California, and then sort of the average across the country, which in the 36 states or so that NCCI provides rate-making services. What we see here is there's been, when they were all pretty consistent for a while, and we track this going back farther, that really they've started to deviate coming out of the Great Recession, where while frequency in most other states kind of went back to the normal pattern of frequency decline that really has been going on for decades in California as well as in other states of around a 3 to 4% decline every year. That didn't happen in California, particularly didn't happen in the LA Basin. The remainder of the state tended to move in the same direction as the rest of the country, but at a much more modest rate. Now, recently, the last year or two, those have kind of come a little closer. In 2016, while California's decline wasn't as great, it was closer to that norm. We don't have the 2018 figure yet broken down regionally, but it's looking that California is going to be relatively flat, which isn't that different what is happening in NCCI states, which are only seeing about a 1% decline. And I don't have a lot of slides highlighting sort of the regional differences, but I did want to highlight this one. This slide looks at the regional differences in indemnity claim frequency. And this is after we control for differences in industrial mix. Clearly, there are different industries in the Central Valley than there is in Silicon Valley. So when you control for those differences in industrial mix and even differences in wage levels, because even for the same occupations, wages are different in different regions of the state. Controlling for both of those, there's still a very significant differential in claim frequency, with the highest frequency tending to be in the Los Angeles basin. Again, no surprise there. And the lower frequencies more toward the Bay Area. And as it's most extreme for the latest year, the LA Long Beach area had a frequency about 32% higher than the state average once controlled for differences in industrial mix and in wage levels, while the frequency in the Peninsula area, Silicon Valley, was about 24% less. So again, a pretty dramatic differences in claim frequency. And again, this is consistent to what we publish every year in our GEO study, and probably no great surprise to most of you. So as we dig down and what's driven some of that differential in frequency that we saw, particularly in the LA Basin, that made California patterns differ from what's happening in claim frequency in most other states. And again, we've talked about this regularly. We published a report last year around the world of cumulative trauma claims that have a number of measures of differences of how cumulative trauma claims are different from other claims with respect to, speed of payment, settlement, litigation rates, and so forth. What we've seen as well, frequency was relatively flat during the frequency of cumulative trauma claims. The percent of indemnity claims for a long period had been relatively flat. Starting in the latter part of the last decade, we've seen a pretty steady increase. So now we're on our preliminary figure, we're estimating about 18% of all claims that involve indemnity, all claims that involve at least some temporary disability, are cumulative trauma claims, much higher than other states. And we think this is one of the key factors that has driven some of the recent differences in frequency patterns in California relative to the rest of the country. Drilling down a little bit into the percent of cumulative trauma claims by region, shows that recent trend of increasing cumulative trauma claims over the last decade haven't been experienced statewide. If you look at the rate in In the Bay Area, really pretty flat, the green line there, pretty flat. Similarly, if you look at the rest of California, other than the LA Basin, the Bay Area, and San Diego, again, pretty flat there, not much growth. Really, all the growth we've seen in cumulative trauma claims have come in the LA Basin, and then more recently, a pretty significant growth in the San Diego area. And again, cumulative trauma claims tend to have some unique characteristics. They're often reported late. They're very frequently denied, at least in part, if not in whole. They're almost all litigated. About 40% of them are filed after the worker's been terminated. So some very unique characteristics that we think drive some of the differences we're highlighting and will highlight in this report comparing California to other states. Another key factor that tends to make California a high-cost state is the proportion of claims in California that involve permanent disability. So this shows the frequency of permanent disability claims per 100,000 employees. It's based on NCCI information that they collect for other states, and we provide the California information. As you can see, California is significantly darker. Its frequency of 774 per 100,000 is by far the highest of any state, and also about 250% higher than the national median. And we've looked at this has been true for a number of years. We've tried to understand the dynamics of why that is. If you look at the typical industrial mix, are there more industries that are prone to have serious claims compared to the typical state? And California isn't. In fact, its industrial mix is a little less severe than average. If you look at, the catastrophic type claims, the death and permanently total claims, California's proportion is about normal given its population. If you look at the AMA Guides, 5th edition, which are the basis for determining permanent disability in California, and compare that to other states that use the same guide, well, those other states are far less green or much lighter shade here. So it's not the AMA Guides 5th edition. So it really kind of leaves you with, it's the interpretation, the administration, things like cumulative trauma, things get permanent disability in California that don't in other states. That's kind of highlighted despite having the same system. When you look at the permanent disability rate of permanent disability claims in the LA Basin compared to the rest of California, they're significantly higher than even that 774. Let's move on to claim severity. Little different story here. This looks at the change in the average indemnity cost per indemnity claim. And while there was some increases in benefits coming from SB 863 that drove the increase we saw in 2014 and maybe a little residual impact in 2015, other than that, over the last 6 or 7 years until recently, we've seen, modest, steady declines in the average indemnity cost per indemnity claim in California. That's despite, growth in wage levels. As you know, indemnity benefits, most indemnity benefits are a function of the injured worker's weekly wage. And despite growth in that, we're seeing, we've seen for most years decline. And that's really been driven by two factors coming out of the reforms. One, we've seen reductions in temporary disability duration, some of it probably from some provisions coming of SB 863, but some of it coming back from a healthy environment and maybe employers incentivized to get workers back very quickly since it's more difficult to replace a worker who's not there in this economy. Secondly, we've seen kind of a steady decline in the average permanent disability rating, and those are really the two key factors that have tended to drive that down. We do see a sharp increase in 2018. That's the highest increase we've seen indicated for some time, as you can see on the chart. It is still a little green. We're expecting maybe that to come down a little bit, but not turn to a negative, certainly not expecting to turn negative or close to zero. So it may be indicative to a return to some more normal long-term rate of inflation in indemnity claims. This kind of highlights the very modest growth in indemnity costs in California over the last couple of decades. And the green bar is what's happened to the indemnity severity in California. The yellow bar is, wage level growth in California over the last 20 years. And then the blue bar is sort of the national average in the NCCI states of average indemnity severity. And while California has grown only about 2% per year over the last couple, California workers' comp, only about 2% as opposed to about 4.5% in wage level and about 5% in, the average in NCCI state. So very, very moderate. And some of that's been driven by really the dramatic reforms, impact of SB 899, coming back in the 2004, 2005 area, as well as, this very flat to modestly declining SB 863 period. Well, let's turn to medical severities, the average medical cost per indemnity claim. And again, a very cyclical pattern with sharp rates of growth in the 90s, really all the way up to the SB 899 reforms that happened here. Then coming out of those SB 899 reforms, another period of sharp increases that really led to the SB 863 reforms that brought medical down in the post-2012 period to where the average medical cost now we're estimating for 2018 is only about $32,500 compared to about $40,000 back in 2010. So that really is driven by the impact of reforms. We did this dotted comparison, said, well, what if that pre-SB, post-SB 899, pre-SB 863, this medical inflation rate continued. Instead of being about $30,000, the average medical cost would be about $60,000. So from one way to look at it, that's about $30,000 a medical per indemnity claim that's potentially been saved from the SB 863 reforms, some of the reforms that came subsequently, some of the anti-fraud efforts and so forth, saved maybe as much as $30,000 a claim, which if you equate to roughly 200,000 indemnity claims in the system, I think the arithmetic works out to about $6 billion a year. So real dramatic impact in kind of taking that rate of inflation down to, really a steady deflation. Now we are starting to see a turn up, and we'll talk about that in a couple of slides. This, similar to the prior slide for indemnity, indexes medical cost level back to 2001. And really, since 2001, medical in California has essentially been flat since we've had, in those 15 years, there have been two significant reform periods, the SB 899 reform period back in 2003, 2004, and the SB 863 in the post-2012 period. So medical costs have been essentially almost flat in California the last 17 years, as opposed to NCCI states, they've grown by about 3.5% per year. And group health during that period, by some of the measures we were able to find, has been growing by about 7.5%. So a pretty dramatic, difference in where medical inflation's been in California compared to some other systems. This looks at the year-to-year change in that average medical cost per indemnity claim. And you can see the high numbers coming from the post-SB 899 period, then that significant period of deflation that happened with SB 863 and subsequent reforms, till, starting to kind of come back to maybe a more modest rate, more typical rate of growth, which is more consistent with other states, more consistent with general medical inflation. Starting to come back. Now that also may moderate a bit. That 2018 figure of 3.5% medical inflation may come down a bit, but we think we are seeing signs that medical inflation is returning to a more normal pattern, but we're seeing the signs we're showing are suggesting kind of a soft landing, a modest medical inflation rate coming out of the SB 863 environment, not the high rates we saw a decade earlier. And I think this is, I got a couple of slides here on pharmaceutical, and this has been a pretty remarkable part of the story. This looks at pharmaceutical costs indexed back to 2012, so prior to SB 863, looks at the average paid per transaction, the number of transactions, and then the average paid per claim. And almost a remarkable story if you look at the bottom green bar there, that compared to the average paid pharmaceutical per claim in California is only 20% in 2018 of what it was back in 2012. A pretty remarkable story. Lots of reasons for that. It's hard to attribute to any one. They include things like independent medical review has affected pharmaceutical costs dramatically. There was a fee schedule changes that the federal government implemented in 2016 that had a dramatic impact on that worked its way into the California system. It had a dramatic impact on the average cost of generic pharmaceuticals. Anti-fraud efforts have affected pharmaceutical less spinal surgery. The formulary in 2018 has been a very positive impact in driving down costs in 2018 service year. So a number of factors have driven this, but again, it's pretty remarkable to see that 80% reduction in only 6 years. The story in opioids has even been more dramatic. This is, we've tried to identify in 2013 to 2018, the opioid cost per 100 claims. And you can see it's gone down from 16,000 to less than 17, to about 1,700, almost a 90% reduction. So while all pharma costs is down about 80, opioids is down even, at a more significant rate, down around 90, which is, pretty dramatic. This summarized as a slide from a recent study that we did earlier this year that our medical analytics team did on the impact of opioid use. So this looks at very similar claims that are similar in types of their level of pain, at least it's classified by the CDC, the types of injuries, the age of the worker, looking at similar claims. What are the differences 4 years down the road of claims that involved heavy, high-risk use of opioids and those that had very low dosages of opioids? And you could see that not only are the medical costs of the heavy users of opioids on these similar claims 2.5 times higher, but it's had an impact on indemnity being about 2.5 times higher as well. So which means that people with heavy use of opioids aren't getting back to work as quickly, are out longer, probably having higher permanent disabilities as well. Let's move on to claim duration. This looks at the percentage of ultimate medical costs paid at 3 years. The black states are states we don't have data for, based on some NCCI information for the other states. And in that case, California is the lightest of the colors, is the slowest. While the typical state has about 70% of the medical dollars paid out at 3 years, California is not even halfway there, only at 49%. That's sort of the bad news. It takes a long time to get through the medical process. The good news is it's faster than it used to be. When we looked at that total 6 years ago, California was still the slowest, but was only at about 38%. So some pretty dramatic differences, some improvement. A lot of that's driven by the cumulative trauma claims. As I mentioned, cumulative trauma claims are reported later, stay open longer. Also, the high proportion of permanent disability claims, those tend to stay open longer than other types of claims, and also the high rates of litigation in California, high rates of representation in California, and all the frictional costs. All these tend to mean that while California is not necessarily a high medical cost state, it's about the median. What is unique about the medical process is it takes longer. Claims are open longer, and that medical does get paid out over an extended period of time. However, more on the good news, if we look at how quickly claims are closing, so some of the reforms on liens, some of the processes around independent medical review, many other things have kind of driven the settlement rates up, so claims are getting settled faster. What this chart shows is of all the indemnity claims that were open at the beginning of the year, how many closed by the end of the year. And as you can see, really over the since bottomed out at only about a fifth of the open claims at the end of 2011 closed by the end of 2012. Well, if you look at all the claims that were open at the end of 2017, that closed by the end of 2018 was almost a third. So a dramatic improvement, dramatic steady improvement in how quickly claims are closing in California, and really the highest rate of closing we've seen since way back in 1998. Let's go into those frictional costs, because this is where California is truly an outlier. This looks at unallocated loss adjustment expenses to loss, comparing California to other states. What unallocated loss adjustment expenses are all the costs around settling and administering claims that can't be allocated to an individual claim. The biggest piece of this is the cost of claims adjusters, whether they're insurer staff or third-party administrators. California is by far the highest. The median is only 7.6%. As a ratio to loss, California is about 13.6, the highest state in the country. And when you look at the other piece of loss adjustment expense, those that can be allocated to a claim, and the biggest pieces of this tend to be medical cost containment and defense attorney fees, California is also the higher, more than twice the median, and clearly the greenest of the green on the chart at 22.9 compared to a median of 10.6. So significantly high costs. And we've talked about some of the reasons. Cumulative trauma claims are high, lots of permanent disability claims. Med legal is very significant in California. Medical liens drive both unallocated and allocated loss adjustment expenses. So many issues that make California a high cost state. We did a quick comparison here from our GEO study that I think will scheduled to come out in October for the update, to look at, how does this vary across the state? And it does vary, as in many things, much higher in the basin, the LA basin, in terms of frictional costs compared to incurred losses. A little bit higher along urban areas, more attorneys, and some of the rural areas. But you can see at its extreme, and this is at first report level, unit stat report level, those differentials will grow as the year develops. LA Long Beach is about 10% allocated loss adjustment expense as a percentage of incurred loss, while only a little closer to 4% way up north in the far north region of the state. This chart really tries to put some perspective on what it does to deliver $1 of benefits, and it's pretty dramatic. And what we do here is not just take loss adjustment expense, but we move things that are indemnity and medical that are really frictional costs, like the applicant's attorney fees, which are in indemnity, we move them to frictional costs here, and medical legal, which is largely in medical, we move it to frictional costs. And it's about 54 cents to deliver $1 of benefits, which is more than the indemnity benefits. It's a bigger piece than even indemnity benefits in California, more than twice the typical state, and way more than either Medicare or group health. So dramatic differences in California. Just a couple of slides on sort of what we're seeing about recent reforms. Good news in terms of reduction on lien filings. If you go way back to prior to SB 863, in 2012, there were over 1 million of them filed. And if you think about the typical cost, we estimate, including the unallocated loss adjustment expense, the allocated loss adjustment expense, and the typical settlement, which is around 25 cents on the dollar of demand, it's about $3,000. That over 1 million liens back in 2012 would equate to about $3 billion of costs in the system. Well, they've come down dramatically, first with SB 863 reforms, which included a filing fee, and then later with SB 1160 reforms that went into effect in 2017, which had a number of provisions related to fraud, related to third parties filing lien claimants, as well as a declaration. We've seen dramatic declines. Still a lot of liens, to more than 25,000 a quarter are still coming in, but again, that compares to, you know, 100,000 a quarter for some of this period and even far higher than that, which we don't show on this chart prior to SB 863. So good news in terms of liens coming down. Liens that, since liens were often keeping claims open, that's been a factor in driving claims getting through the system faster, with some of our reduced development, because the liens happen late in the life and, you know, cause a lot of frictional costs. It has some unique impacts, seeing those go down so dramatically. This is just sort of a high-level summary of kind of where we see the valuation of the reform since 2012, SB 863 and some subsequent, and some real, you know, again, from a cost perspective, some very positive things. Higher PD benefits. We think, you know, the SB 863 increases in permanent disability benefits provided about $700 million in additional permanent disability benefits to injured workers with significant injuries. The lien reductions has saved over $1 billion a year. We've seen spinal surgeries go way down. We've seen reductions in payments. We talked about the pharmaceutical cost reduction. There's been a significant impact coming from providers that have been indicted for fraud. They were very significant in terms of driving costs, you know, 6-7 years ago, and now they're out of the system. On the downside, you know, loss adjustment expenses have continued to increase, even though that was one of the intended targets of the SB 863 reforms, was to reduce loss adjustment expense. You know, we haven't seen that emerge. That's continued to increase. We're seeing at least about $3 billion a year in net savings. There's probably some more savings coming up from indemnity that we're still looking at. So again, a very positive results from the reforms. Higher permanent disability benefits for seriously injured workers, but lower costs in many areas like liens and as well as some positive impacts on anti-fraud efforts. So what's this all mean in terms of the industry? Pretty healthy market. This looks at the concentration ratios, how much of the market, the top 5, top 10, all other insurers have written. And as you can see, it's really at a low, at least over the last 25 years or so that we've been measuring in terms of the market share written by the top 5 and the top 10 insurers. So again, very non-concentrated market. You know, several hundred insurers writing business in the state. You know, so from that perspective, the market's been pretty healthy. Similarly, when we look at industry results, these are our projections of combined accident year loss and expense ratios, shown for the three components. 2018 is our 6th consecutive year we're showing with a combined ratio below 100. Most of them well below 100. So not only compared to some of the other periods where you could see the dramatic cyclicality, where at a high in 1999 of almost 200% combined ratio to plummeting to lows in the 50s in 04 and 05 and back up sharply to 129, it's been probably the most stable period we've seen. Starting to go up, even though the loss environment still looks pretty stable, you know, modest severity trends, you know, pretty flat to modestly declining frequency trends. The sharp decline in rates that we're seeing are driving those combined ratios up. If we had our rough projection for 19, so what we see so far, again, a very modest growth in the loss environment. You know, we're still seeing those modest loss trends, though. Some signs that severity is starting to kick up again, but continued impacts of the rate declines, we expect that to go up probably to the mid to higher 90s for 19, driven really by the sharply declining rates. This tried to take a very long-term perspective and look over the last 40 years, and really what comes out in this decade, you know, both the stability, kind of this is the longest period in the 2010s. You kind of see kind of the longest period of stability. Flat trends don't have the sharp cycles of the prior periods with the very highs and the lows. Comparing California to other states, these are private insurers only to make the comparison valid to the countrywide figure that's available for private figures, and generally followed a similar trend. In the past, California has tended to be a little bit more cyclical, which means the highs tend to be a little higher, the lows a little lower. That's not really the case recently. It's followed pretty close, but California's, really been the last 3 years at least better than sort of the national average. So in workers' comp in general has been very healthy, particularly compared to some other lines like commercial auto that have struggled. And then California's even been a little better than average. Now that's 73. That's a calendar year combined ratio we're showing for California. 83 is the countrywide estimate that the NCCI made. Some of that's driven to some pretty significant reserve takedowns, so that's a little artificial. We think the accident year is probably a better measure of around 90% is a better measure of really what the true combined ratio is, as those figures are deflated somewhat by reserve takedowns on older years, which impact the calendar year 18 result, but doesn't impact the calendar year, the accident year 18 result. So in summary, pretty healthy state of the system. Most of the trends are very positive. The positive trends we've seen in the last couple of years have continued. Premium levels are going down, but that, for the most part, that's been supported by, favorable loss trends. And we expect premium levels to continue to decline as those rate decreases are going to more than offset the economic growth we're continuing to see in California. The insurance market, pretty healthy. It's a non-concentrated market. The concentration levels are the lowest we've ever seen them. Rates continue to decrease, but they're still on the high end. As we said, even with these decreases, California is on the high end in the nation, as many other states have also seen decreases. Well, what are the key cost drivers? Cumulative trauma claim frequency continues to increase. Particularly in the Los Angeles basin and San Diego area. Severity declines. We had a period of declining severity. We seem to be coming out of that. We're beginning to turn upward, but it looks to us, again, more of a soft landing, not the sharp increases we've seen coming out of prior reforms. Claims closing rates are continuing to increase. We don't see signs of that turning around. Claims are getting through the system faster. Again, a positive. I think, what's not so positive is loss adjustment expense, frictional costs continue to remain, clearly the highest in the nation from a wide range of measures. So while there's been good news is in terms of the loss side, loss adjustment expenses continue to be very, very high in California. And, those regional differences that have been with us for as long as we've been looking at the data continue to be there. The Los Angeles basin continues to be more costly in terms of frequency, in terms of frictional costs, in terms of a number of other factors than most other regions of the state. But that said, favorable industry results, stable combined ratios, 6 years of combined ratios less than 100. We think while 19 is going to increase well into the 90s, we expect it to still probably be below 100. And again, what's driving those increases in combined ratio aren't the loss environment, but lower rates. And again, the recent legislation has been a big driver of these rate decreases we've seen since 2015, with reforms saving about $3 billion annually, and significant savings in areas like Lien, spinal surgery, pharmaceutical costs. We think the anti-fraud efforts over the last year have also been significant in driving costs down. So that's, I guess, about a 45-minute or so high-level summary of our State of the System report that we released last week. It's the full report on our website. It's also in the handouts panel. I do have a few minutes. If we have any, haven't gotten any questions at this point, we'll hang around for a minute or two, see if there's any questions. If not, we'll see you at our next research webinar. I think So hearing that, we really thank you for your participation. And again, if there is some questions that come to you, feel free to email it to us at communications@wcrb.com. I did say that right. So, and we'll try to get back to you. So again, thanks for your participation. I think we'll have another research webinar around our rate filing that will make the latter part of next month. And I don't know if we have it scheduled yet, but once we issue the rate filing, we'll get something out to schedule that webinar. So again, thanks for your participation, and we'll look forward to talking to you again later this year.